All right. So I guess now I must be audible and visible both. Chaliye. Can you please confirm if I'm audible now? Everyone? I guess I must be. So you all need to confirm it over here. Everyone, very good morning. People in the class, welcome to the session. Very good morning. How are you all? All good? Everyone? All set? Just a minute. All right. So we are all fine and let us get started. In the last lecture, when we started basics of AFM, we learned a lot of things. A lot of things like what? A lot of things like earnings per. So we learned about the basic ratios. For example, what is EPS? What is P ratio? Right? What are the different variations of dividend which you see here? What is market capitalization? What is ROE, book value per share? Different things we read. But someone can wonder, okay, sir, you have been teaching all these things, but where will these things be used? So let me tell you again, although I mentioned it yesterday, but I would want to clarify it again that these things may not be particularly related to any chapter. Else we could have studied it over there only now. For example, EPS will be used in the chapters of mergers acquisition, will be used in the chapter of equity and business valuation, can be used in some other chapter as well. Which means it is a in general thing which may be used anywhere across AFM. Hence, we should not relate it particularly to any chapter. But more importantly, what should be the approach then? Right now, you should know what is EPS. Whenever it will come to a particular chapter, we will learn over there how to apply it. For example, right now, you should know what is the P ratio. Whenever it will get up, like whenever it will be there in a particular chapter, we will learn over there how to use this number. What can be calculated using that number, all that we will learn over there. Right now the objective is limited, understanding and learning what is P ratio including its formula. Am I, people in the class, clear on this? Please kindly confirm. So if I have to pick up yesterday's topic, yesterday's as in day before yesterday in the last lecture, sir, we ended up our topic while discussing required rate of return and types of cash flows. These two topics we were simultaneously covering up. Let me again give you a brief about it so that I can continue and complete these topics, so that after this we can start officially with our first chapter, which is equity and business valuation. All right, cool. Let's start. Yesterday I said, sir, if I have cash flows for future. Shreya, very good morning. Hello. So if I have cash flows, right, which are for future years, in future obviously there will be some inflation, right? We said, sir, price today is 50. In the future years, the price will increase. Assuming the inflation was 10%, we said the price which is 50 right now will become 55 at the end of first year, 60.5 at the end of second year, and we said it will be 66.55 at the end of third year. These will be the prices which will actually prevail in the market at the end of respective years, correct? All right. Then we said, sir, if we don't give the effect of inflation, which means, acha, tell me, what is inflation? Increase in price, correct? So if we don't give the effect of inflation, which means if we don't increase the price, then what will be the cash flows? So we said, okay, hold on. Let's assume the price to be 50-50 only. And my total cash flows are what? Sir, my total cash flows are quantity into price. So suppose I sold 100 quantity, 110 and 120 quantity at the end of respective years, and if I multiply it with the price without the effect of inflation, I will get the amount of cash flows. Those cash flows which do not include the effect of inflation are called as real cash flows. Look at this, I said quantity into one. One is this price without inflation is real cash flows. And nominal cash flows means the cash flows which naturally include the effect of inflation in them, which is quantity into the second price, which is quantity into two is nominal cash flows. This is what we have read yesterday. I'm not teaching anything new. I'm briefing up again the things that we have read yesterday. My point here is you should be learning this thing with two objectives. One, you should be clear with it today. You should be clear with it today. At the same time, you should write it in a manner that you would be able to understand it later on. At the time of revision, you won't be able to listen to me, right? So we should try. Listen to me very carefully. This is most important thing. Whenever you write down anything in the handmade notes, you should try to write it down in a manner that whenever you are referring it on a future, like at any point at the time of revision, you should be able to understand it. I have tried my best to create notes in such a manner, in such a flow, right, that you are automatically able to revise the things in a very smooth manner. However, while teaching, I get to realize that, okay, let me teach this. See, let me tell you, this was not my initial plan. I was just planning to explain these things to you on a lighter note. But then I thought, why not to explain it? Why not to explain it in depth? Which is why I immediately inserted this kind of an example, which means if you make it, make sure we are able to make it in a manner, don't want to repeat, make it in a manner that you're able to quickly revise it. All right, chali. So yesterday we said, okay, these are nominal cash flows, these are real cash flows. Sir, how does it matter if the cash flow is real or nominal? How does it matter? It matters, it matters because we have read cash flows can be compounded or discounted. Cash flows can be compounded or discounted. Primarily, what we need to learn for the purpose of AFM, primarily discounting will be of use, calculating present value will be of use, right? Then we have read that for the purpose of discounting, the rate which is used to discount the cash flows is required rate of return. How much I require to earn depends on the risk which is involved. If there is a higher risk, I would need a higher return for taking that risk. Hence, my required rate of return will be more in that case. So, how much is the risk involved in those cash flow matters? If my cash flow is coming from a bond, which, so suppose I've invested in a bond, the bond has a lower risk. The cash flows will arise from the bond which has lower risk. Hence, my required rate of return will be low. If I invest in a business which is of high risk, which means the cash flows that I will generate from business will have a higher risk. Hence, my required rate of return in that case, if I compare it with bond, will be higher. Are you understanding? Which means that risk premium is that element which says higher risk, higher return. As I said yesterday, premium means extra return on account of what? Risk premium, right? On account of taking extra risk. So sir, similarly we said, since the cash flows can be both real and nominal, right? Let me take you back to the point. Since the cash flows can be both real and nominal, we need to take a rate which is aligned to the cash flows. If my cash flows are real, right? In the required rate of return, as we read yesterday, which has three components, required rate of return has real risk-free rate, which means it is the rate which you deserve to earn if the cash flows are real and if the cash flows are risky. However, if the cash flows are not real, if the cash flows are nominal, you deserve to earn an inflation premium as well. And if the cash flows are risky, you deserve to earn a risk premium as well. The point I'm trying to make is that accordingly you can make the possible combinations. If the cash flows are real, obviously, the rate the rate using which you will discount will also be real. Yes, which means you will use this rate. However, you will have to figure out if the cash flows have risk or not. If the cash flows don't have risk, which means they are risk free, use only risk free real rate, risk free real rate. However, if cash flows have risk, which means you deserve to earn a risk premium as well, so you will use real risky rate, which means adding only 1 and 3 but not 2. However, if the cash flows are nominal, which means in the cash flows the effect of inflation is included, then obviously to align it, the effect of inflation should also be included in the rate, which means this will surely be there. Now figure out if the cash flows are risk-free, then use risk-free nominal rate, only 1 and 2. However, if the cash flows are risky, which means not just inflation premium you deserve to earn a risk premium as well, you will take 1 and 2 and 3, which is the nominal risky rate. People in the class, all of you need to confirm. Could you very well understand whatever is being taught? Everyone. We have spent around 10-15 minutes extra to understand what was already being discussed yesterday. Now that you have a base, we can proceed with it very quickly. I just need a quick response from each one of you if you are settled or not. Everyone, very quick. Proceed. Yes, we are set. Obvious? And I'm assuming that you are simultaneously writing it up as well, because my speed is quite manageable for you to simultaneously write down in the assignment notes. All right. Now let me proceed. Take you back to the cash flows. Where is that? On the, all right. So come to this page number 7. Since the cash flows can be nominal and real, you all clearly understood that, sir, if I want to convert a nominal cash flow to real or a real cash flow to nominal, how do we do it? Simply by giving the effect of inflation. As we read yesterday, whatever is your real cash flow for for any number of year. For example, real cash flow for second year. If you want to find out nominal cash flow of second year using the real cash flow of second year, you will have to do the 1 plus inflation to the power 2 for 2 years, simply saying, right? Similarly, is there any relationship? Similarly, is there any relationship between this real rate and between this nominal rate? Yes. The difference between real rate and nominal rate is the effect of inflation, right? And as I said yesterday, you don't have to add it simply. The nature, the mathematics between them is not additive, it is multiplicative actually. Sir, multiplicative in the sense, let me tell you. Imagine that, let's ignore risk premium for now. Imagine that real risk-free rate is 5%. And inflation premium is 3%. You don't have to add it 5 plus 3 as it is. What will you have to rather do? You have to give a multiplicative effect. How do you give that effect? Let me teach you. Sir, the relationship is 1 plus rate. N would represent nominal. 1 plus rate, which is nominal, is equals to 1 plus rate, which is real, multiplied by 1 plus inflation. Meaning to say, if your risk-free rate is 5%, you will have to say 1.05. And if you say your inflation premium is 3%, you will have to say 1.03. So 1.03 into 1.05. Ideally, I had to add them up, but here the effect is you are adding it ultimately, but in a multiplicative manner. Sir, from that, if you deduct 1, sir, which one? This one which is here. If you deduct it, what do you get as an answer? Let's use your calculator. Everyone use your calculator, please. 1.05 into 1.03 minus 1 is equals to 8.15%. Obviously, it is 0.0815, but multiplying it with 100 by 100 give me 8.15%. Obvious, basic, easy. This is how we can convert a given rate, real rate to nominal, nominal rate to real, which means, you know what? What is the beauty now? The beauty is that if examiner gives me real cash flow and if examiner gives me nominal rate, I will have two choices. Either I can make the cash flow nominal so that these two things become aligned, or I will make the rate real so that these two things become aligned. But what I should always know is that cash flows and rate should be aligned to each other. Am I? Everyone in the class, clear please? Let me now take a very quick example, but I'm wondering if I should take it now or not. Hold on for a minute. Let me think, because I think we should be taking it when we start to do capital budgeting. Chalo, let's do it now. Since we already have some kind of framing in our brains, it will be like it will make your concepts further better. Let's take this example. Sir, Cipla Limited has forecasted cash inflow of rupees 100 crores to be received at the end of second year. There's this company which has estimated that at the end of second year, I am going to receive 100 crores. Real discounting rate 10%. Right? Cool. 1 second. Rate is real. What about the cash flows? Are they real or nominal? We will think. Real discounting rate is 10%. Inflation in the economy is 5%. Calculate present value using nominal and real discounting rate. We have to calculate the present value once using nominal discounting rate, then using real discounting rate. If we are using nominal rate, both the cash flows and rate should be nominal. If we are using real rate, real discounting rate, both the cash flows and rate should be real. My question to you all is, this is real rate, fine. This is inflation. So basically with the real rate and inflation, I can find out nominal rate, which means now I have both real rate and nominal rate. For what about the cash flows? Cipla Limited has forecasted rupee 100 crores of cash flow to be received at the end of second year. You all need to think. Everyone in the class who's present, you all need to think if this 100 crore given in the question is nominal or real. Now you say, if the given cash flows are nominal or real, take a minute, think, and then respond. In the meantime, I will watch some reels. Think, and tell me. Guess. Figure out through the language. Figure out through the language. Recorded people, have you thought? Because if I find any student who is fast forwarding the lecture anytime I give you a time to think, you can't make it fast forward, you'll have to actually think. So let me tell you, as I taught it to you yesterday, everyone, all the cash flows in actual world around you, all the rates in actual world around you are always nominal. Tell me one thing. This quantity, when you sell, let's imagine that we are talking about the second year. This quantity, when is sold, what is the actual price at which it will be sold? 60. So what is the actual cash flow that you will receive? This. So if company has forecasted 100 crores to be received, what will company actually receive? What happens in the actual world is always nominal. Because on that day, whatever rate will prevail, at that rate you will receive the cash flow, and that rate includes the effect of inflation. Hence, everything in the real world is nominal. I mean, everything in the actual world is nominal, right? Hence, this cash flow is nominal. So if I want to discount that using nominal rate, life is easy, right? Let me write down. I would say, oh my God, now this is a real pressure to me, because I'll have to make sure my handwriting looks good to you. Kindly consider, you know the boys effect. All right, come. Because obviously we cannot make the things very beautiful, right? All right. So nominal cash flow at the end of second year is what? Rupees 100 crore. What is nominal rate of discounting? So basically you know that relationship, right? 1 plus nominal rate into 1 plus real rate is equals to 1 plus real rate into 1 plus inflation. So if I have to find out this, as we did, 1 will be taken here and will be deducted. Alright, so come. So it will be like nominal rate will be 1.1 1.1 into 1.05 minus 1 will give you the nominal rate as what? You won't have to depend on me. Find out this answer as your own and write it down. This should over the time be a habit. Huh? When you are following me, follow me in the concept. But when it comes to calculation, you should either be ahead of me, or you should be, at par with me. Do your calculation. So it is turning out to be 15.5%, right? So let's calculate the present value. So present value will be 100 crores at the end of second year to be discounted by obviously compounding discounting. One divided, compounding discounting basically this thing. See this, check this out. See over here you can very well understand that, sir. Basic. See this. Although I was supposed to explain it over here as well, but it is quite basic. I know that I don't even need to teach you this. Something very basic. That, sir, if I have a future value, can I divide it by 1 plus r to the power n to calculate the present value? Obviously. So 1 plus 0.155 to the power 2 and you will get the present value. What are you getting as the present value? I need an answer. Everyone, I literally need an answer. What are you getting as present value? So 100 divided by 1.155 equals to is 74.96 rupees, 74.96 crores. Yes. So next one. All these are basic examples. None of these are exam questions, right? This is just to build a base in your brains. So let's discount the things using real rate. Sir, I have nominal cash flow at the end of second year, which is rupees 100 CR. Now I need to discount this cash flow using real rate, which means I need to first have the cash flow which is real. So let's convert it to real cash flow. So real cash flow at the end of second year will be, I want to give you 15 seconds for you to do it at your own. Everyone, before I proceed. Literally 15 seconds, use whatever information you have on this page, use it, but give me real cash flows. Live people, recorded people. Give your best and give me the answer. $90.70 is what is being spoken as the answer, which means, sir, what I will have to do is that, sir, I will have to take 100 CR. 100 CR, so obviously you have to understand what is happening. I have nominal cash flow. I have inflation rate. Obviously for 2 years I will have to consider. Can I find out the real cash flow? Obviously, sir. So real cash flow at the end of second year will be nominal divided by 1 plus what was your inflation rate? 5%, 0.05 to the power 2. Let us calculate 100 divided by 1.05 equals to, it is 90.70 real cash flow. Brilliant, amazing, great. So rupee 90.70 crore. Now I need to calculate the present value. So you need to, through this, the purpose of taking this illustration is that you have to realize that these are two different things. Calculating real cash flow does not mean calculating present value. This was just eliminating the effect of inflation. I want to take you to this depth. Everyone, please understand. I want to really take you to this depth. Suppose you have a cash flow. You discount it using a rate, for example, for 2 years. You discount it using an interest rate whenever you want to calculate the present value. right? Please understand this rate has two components, as you know now. Sir, one is real rate and another is inflation effect. Correct. So over here you have just considered the inflation rate only, and you have not done the complete discounting. Hence this is not the present value, this is just the real cash flows, right? The second element, which is real rate, will happen now, and that's when you will say present value has been calculated. Are these details helping you out to build that clarity, to have that clarity, to understand that, like to build that base, strong base, which will be used across AFM? People, CA people, CMA people, give me this clarity, give me this feedback, right? So, sir, present value now will be real cash flows, which is 90.70 divided by real rate, which is 1.1 to the power 2, which will give me present value as 90.70 divided by 1.1 equal to 74.96. Oh my God. 74.96 crore rupee. Sir, what are you saying? Which means you want to say, sir, that if whether we use real rate or nominal rate, irrespective of what we use, the present value remains the same, which is why I wanted to make you all do this illustration and understand the thing with clarity. Obviously, na? Present value means today's value. So future cash flows cannot have two different present value. Whatever method you use, irrespective, the present value has to be the same. There can't be two answers to one question in maths. Settled are we, everyone? I need a quick feedback. Sahil, are you settled? Rest of the live people in the class, are we settled? And recorded people, are we settled? Boliye. Sorry, speak up. Quick, quick, quick. You know what? With time, we will speed up our lectures. All right. Obviously, it is not now. It's when you're comfortable with our teaching methodology, with the language, with everything. Okay. Sahil, are you comfortable with language? Rest of the live people in the class, are you finding the language friendly? Are you finding it easy to process or rather difficult? What do you all say, everyone? You'll have to be fair, huh? You'll have to be fair. As in, if you're not comfortable, you'll have to say no. And if you are, obviously, you'll have to say yes. It is your first time English bad. I understand. I understand. At any point, all the live people, you have this opportunity in hand. At any point, if you feel like that you're not comfortable with anything, without hesitation, you will have to and you should ask your doubts without hesitation. If you feel that, sir, I listened to you very carefully, I'm not, and then despite I didn't understand it, you have rights to say, sir, kindly repeat. Right? Chalo. Anyways, so we are done with almost all the basics. We are done with almost all the basics. Now we need to understand only one basic in this. As in, except for this, we are done with everything. We need to understand internal rate of return. So I have taught to you what is required rate of return and what is expected rate of return. These two are finance terminologies. In the sense that required is what I want to earn, my need, required. Expected is what I think, what I estimate I will be able to earn based on the future prices of that asset, of that share, of that security. Internal rate of return is none of these two things. Internal rate of return is rather a technique Please understand, over here I don't want to teach you what is internal rate of return. I rather want to teach you how to calculate internal rate of return. People in the class, this is simply a technique. Technique of what? Let me tell you. If I give an example, that suppose you invest 100 rupee. Suppose you invest 100 rupee in a share, which is expected to become 110 after a year. Right? Suppose there is no dividend. What rate of return you think you will be able to earn? What rate of return you think you will be able to earn? So 10% expected rate of return, right? This is what you have done. Fine. Now assume that you don't have, now assume that you have, see, this was the case of just one cash flow, which is for 1 year's cash flow. Now imagine that you have multiple years. Sir, I invest 100 rupee against which I will get 60 at the end of first year and 60 after that. Correct? My point to y'all is, everyone, my point to y'all is, if you invest 100 rupee and if you receive 60 and 60 at the end of year 1 and 2, obviously we are not able to apply the above common sense. Over there it was easy, P1 minus P0. I understand that I have earned 10 rupee by investing 100 in a year, hence my return is 10%. You cannot apply similar logic over here because here there are multiple cash flows. Are you understanding? This is the problem. The problem is, how do I calculate the rate of return I have earned where I am sure I have earned something? Common sense. When you put in 100 and when you get back 120, then 100% you earned something. Yeah, whatever you receive over and above your original investment is your return. You invested 100, getting 120, then obviously you have earned rupees 20. But you cannot say 20 earned. Like, how would you calculate a per year return? Is the problem, right? Which is exactly the situation the concept of IRR solves. Over here, my focus was not to explain to you the formula of IRR, rather the background, the context, the understanding behind IRR, that when do you apply IRR. I know in Inter you have all been through with the IRR, but how can it be used was my objective to teach. Right? Chaliye. So suppose the situation is there where, sir, I have invested 110 and I will get back 11 and 121. Everyone. Let's imagine that you have invested 100 rupees against which you will get back 11 and 121 at the end of first and second year. First of all, apply your common sense. This is one of the most important thing we will do in the entire AFM, applying common sense. Apply common sense that, sir, if it is 11 and if it is 121, which means in total I will get back 132. And if you invest 110 and if you receive 132, then obviously you are earning something. In percentage terms and annualized percentage terms, how much it is? Sir, let us calculate. As we have learned it in the Inter, that, sir, let me plan how should I present it to you. Hold on for a second. In fact, so that we can save on time, let me bring it to you from this place so that we can save on time and I can focus on explaining. Hold on. See this. Don't focus on writing right now. We will do the writing and everything. Focus on understanding things. Sir, first of all, to any AFM's question, the best thing you can do is to present it on timeline. Life becomes easy. Alright. Sir, at 0 point, I have invested 100 rupee. At the end of first year, I am getting 11 and 21. Negative cash is in outflow, which is a negative cash flow, is in red color. Positive cash flows, which are inflow, is in green color. My question is, at what rate? At what rate should I discount 11 and 121? At what rate should I discount these two numbers so that it can be equal to the present value of 110? That's what the IRR is, right? Back calculating this rate, which makes the present value of future cash inflows present value of future cash inflows equal to my outflow of 110 at point 0. How do you back calculate this rate? Using trial and error method. We say that 110 is what I want. Inflow should be equal to outflow, right? Present value of 11 and 121 for year 1 and 2 respectively. At what rate should they be discounted so that I can get 110 as their present value, right? And R, there is no specific formula to calculate R. You will have to do trial and error. First, you will have to put 10%, 11%, 15%, whichever number gives you the answer. Whichever R assumption, whatever R you assume, you have to assume such a number that the present value is 110. Purposefully, I have taken the numbers such that you would be able to easily find it. Kindly do this quick trial. Assume 10%, 15%, whatever, 11%, 8%, whatever you feel, and calculate the present value. Obviously 10% seems to be a direct answer. So discounting 11 divided by 1.1 equals to m plus, and then 121 equals to m plus. Memory recollect. I want to teach you something. Hold on. I want to teach you something. On your calculator, see, we want to learn how to save time in exam. We want to learn how to save time in exam. Please learn to solve it manually with me on the calculator. Some of you might know this shortcut trick, some of you might not. So listen to this carefully. On your calculator, take 11, divide by 1.1. 11 divided by 1.1. As you do equals to, it becomes 10. Since it is power 1, you do equals to only once, right? And it is m plus. Correct? Take it. If I don't teach you anything, what will you do now? You will take 121 on the calculator, you will divide it by 1.1, and you will do equals to 2 times. 121 divide 1.1 equals to 2 times, and then you will do m plus. Let us do that once. All right. So I take 121 divide by 1.1 equals to give me 100, m plus, and memory recollect if I do is 110. Which is the same as the present value which I wanted, which means 10% is the correct answer. The shortcut I want to teach you will be now applied. है ना? Please be here, listen to it. Sir, what I want you to do is take 11, divide by 1.1. So 11 divided by 1.1 is equals to, 11 divided by 1.1 is equals to 10. As you are getting on your calculator, m plus. Done. Now you don't have to write 121, now you will have to take 121 on your calculator, but for that you don't have to now divide and do 1.1. that is already fed in the memory of calculator. You don't have to divide 1.1 square. Just take 121 on the calculator, and if you press equal to, it will naturally divide. If you again press equal to, it will naturally divide once more. So point is, after this terminology is done, just write 121 equal to. Suppose there would be one more terminology, 136 to the power 1.1 to the power 3. So next you will do 136 equal to. You don't have to press divide by 1.1 every time, is what I'm trying to teach you. For each terminology, 1.1 to the power 1 is already fed in the calculator while doing this part. Could I please explain? Right? So anyways, 121 equals to m plus, memory recollect, we give an answer of 110, and hence this was a quick recollection of how do you calculate IRR. Right? Chalo. Sahil, was it a new one to learn, or was it an obvious thing? Was it a new thing to learn, or quite obvious? Rest of the people. So we are over here, everyone, all done with the basics. If you look at something on page number 8, these are the ratios that we will write down as we proceed to solve the questions for the AFM. All right. So this is all done. We are now we are going to start officially with this discussion of equity and business valuation. All right. So just take a quick 2-minute space. Take your breathing time, settle down the things, and then we can full-fledgedly start. All right? Yeah. Cool. Done. So just give me a minute. Let me settle down. Let me have water. Then we start. All right. Let us proceed. Hannah, just 1 second. Yes. So people in the class, as I said, the first chapter. So what will be our sequence of covering the things? Wait. Yeah. What will be our sequence of covering the things? Our sequence will be like in this manner. Obviously, I guess you will have the page number already fed in over here, right? Equity and business valuation will be our first official chapter. If we look at equity and business valuation, right, and comparing with the official study material, it comprises of two chapters. Equity valuation is the part of security valuation, which will be covered over here. And business valuation is altogether a complete chapter in itself, right? Which is also covered in this. So over here, these are the two things we are going to cover. As the name itself is saying, and you won't believe the importance of this chapter. You know what? You know what? So let me give an instance. If you go for an interview, which interview? Interview which is related to core finance profile, capital market profiles like equity research or portfolio management or M&A or any of these kind of profiles. One core skill that you must have is the skill of valuation. And let me tell you, it is being taught in a very limited manner in both CA and CFA. I'm talking about even CFA. It is being taught in a very limited manner, which is why there is a need of a lot of which a lot of students do financial modeling. I'm not promoting it at all, but I'm just sharing with you that when company look at you, they would want you to know the core of valuation, right? Which is the details of which are actually covered in far more detailed manner, right? In far more comprehensive manner, in the financial modeling sessions, right? Why I am trying to tell you that is we don't have to do the financial modeling, but by giving your best in these chapters, you can get a sense of what will be taught in those sessions, right? What is generally being taught in those sessions. And if you are very much clear with the concepts being taught here, you make yourself capable of cracking even those interviews where the questions based on valuations are being asked. So obviously for exam perspective, this topic is important. All the topics are important, but this topic particularly is important even from the perspective of capital market job interviews. All right. As the name itself is saying, what would you learn? You would learn to value a company. Tell me one thing. If you want to be an investor, if you want to give anyone an advice of investing, you would need to know the value of a company. If you don't know how much should be the value of this company, would you be able to comment whether one should buy that company or not? No. You yourself don't know the value, how would you comment? If you want to acquire a company, imagine that in the capital market profile, let me give an importance. Imagine that you enter into a field of M&A. Mergers acquisition, basic thing, you want to acquire another company. I am the acquirer. I have hired you as an investment banker that I want to I want to acquire that company. Do you agree? Do you realize? Unless you know valuation, how would you value that another company? Valuation is needed. Third thing, imagine you working as private equity. I'll give you multiple examples. Valuation is the core of such profiles. I'll give you two more examples. Imagine you're working with private equity and in which you want to do a startup funding. Obviously, you must be reading in the news, right? That this company raised this thing at this valuation. The word valuation, Shark Tank. Unless you know the value of that particular company, how would you raise the fund? Even that is not possible, right? For example, let me give you an example if you're not clear with it. I don't know how many of you are clear with certain basic things being there in the Shark Tank, but let me give an example. You give me 1 crore rupees. I am this startup. You give me 1 crore and you give 1 crore to another startup. For simplicity, I'm saying don't take it literally. The actual calculation is detailed, but that's not here. That's at CFA level 3. But I want to teach you something very basic from there, right? If you give 1 crore rupee to two different startup, sir, if this startup has a value of 9 crore already, and if this startup has a value of 99 crore already, let me tell you, for this 1 crore, you will get 10% equity. Because with your 1 crore, my total value will become 10 crores now. Right now my value is 9 crores. If you give me 1 crores more, how much my value be? 10 crore. In which how much are you owning? 1 crore, which means you become a 10% owner of that company. Similarly, if you give me 1 crore, in this case, my total value will become 100 crores and you will be the 1% equity shareholder of my company. The point I'm trying to make you is that the same 1 crore gives you two different kind of ownership, 10% and 1%. And how is this being decided based on the existing value of the company? Are you now realizing why are those pitches? Why do the startup founders struggle in their pitch for a higher valuation? Because with the higher valuation, they will have to dilute a lower percentage of their equity. Common sense. Valuation is needed. How would you know this 9 crore and 99 crore is what I'm trying to tell you? Yes. One more example. A company wants to come up with an IPO. Exigo, the latest IPO which I saw, I don't know what are the dates, right? The online travel booking companies, tickets booking companies, whatever you call it, right? Is coming up with an IPO. At what price will I have to issue my share to the investors? Would I be able to know? Unless I know my value. Valuation is in the core of every core finance profile is what I want to tell you. You have to understand it really carefully. And it is easy. We will make it easy. All right, let us proceed. Sahil, I have to learn this. Yes, 100% true. Yes, 100%. Let me tell you, I will, acha, remind me, not now, it is the start of the lecture, but remind me at some point. I would want to share with you certain important insights related to capital market related profiles. As a CA, you would be working in auditing. You can work in auditing, you can work in taxation, you can work in FR related profiles, you can work in finance related profile, but not capital market, but maybe banking, or you may work in capital market profiles. I'll tell you what are the differences. I did audit and income tax during my articleship, which is when I realized that I don't want to do this. Hence, I thought of pursuing CF and entered into core finance. Not now I'm explaining everything, but with time, remind me, I'll give you certain insights so that you can see. To me, no one guided what kind of profiles I should be seeking. If I guide you now, you can accordingly learn things in that direction. Pick up that subject with that intensity, which is going on right now. Obviously, it is all your choice. But my responsibility is to tell you how is equity research profile different from an auditor's profile or a taxation profile. Getting it? Or an FR profile or whatever. Right. Audit, your soul died. Literally. Audit was like, so maybe the profile was good, but the bosses were not. I hope they don't listen to this video. My seniors and bosses. Anyways. So let us proceed to have this discussion, equity research and business valuation. So let me now guide you. If you come to page number 9, everyone, what is this drawing? You will realize that to calculate the value of a company, we don't have one approach. We have multiple approach. I can find out the value of a company using the dividends of that company. I can find out the value using the cash flows of the company or using the assets of the company or using the earnings of the company, and one more method called as relative valuation. On the basis of different parameters, dividend, cash flow, earnings, asset, I can find out the value of the company. And after I learn to find out values as per different approaches, there are certain other important topics related to valuation. Let us take it one by one, dividend based valuation model. In this case, as the name itself is saying, we will find out the value using the dividends of the company. Sir, one very core rule of valuation that you will use at multiple times in AFM. Core fundamental. That fundamental rule is called as fundamental principle of valuation. Fundamental principle of valuation. And let me tell you, you already know it. I just want to make you realize it. The rule says that value of any asset today, everyone, value of any asset today is the present value of all future cash flows generated from that asset. Whatever cash flows that asset will generate, present value of all those cash flows is the value of asset today. Imagine any asset. Sir, imagine a share. What will share generate in future? Dividends. Imagine a bond. What will bond generate in future? Coupons as an interest amount and the redemption value. Think about any other asset. Whatever cash flows that asset generates, discounting the cash flows to present value will give the value of an asset today is the simple fundamental rule. Sir, logic? Very easy. You tell me one thing. You tell me one thing. Do you agree? I have PV, I have rate, and I have FV. If I give you 100 rupee of PV, if I tell you rate is 10%, let's assume the time to be 1 year in all the case. Can you give me? Can you give me FV? Yes, sir, 110. If I give you PV of 100, if I give you FV of 110, can you give me the rate? Yes, sir, 10%. I think I have given both the examples same. Allow me a minute, I want to restart. Imagine that I have PV, I have R and I have FV. Let's assume the time to be 1 year in all the case. Do you agree out of these three elements, if I know any two, I can find out the third one? For example, if I tell you that my PV is 100 and R is 10%, obviously the FV will be 110. If I tell you that FV is 110 and PV is 100, obviously you can tell me that R is 10. Similarly, if my FV is 110, and my R is 10, can you back calculate for me 100? Yes. The point I want to convey to you is, listen to it very carefully. I give you a situation that after a year, you are going to receive 110 rupees. Let us invest in a project. The life of the project is 1 year. Let us invest in a project. Life of the project is 1 year. From that project, after a year, what are you going to receive? 110. How much do you need to earn on that project? How much do you want to earn on that project? Answer is required rate of return. Everyone, what I require to earn, what I need to earn is the required rate of return, right? And which depends on the risk involved. Suppose based on the risk involved in the project, I need to earn 10%. Which means, do you agree? This 110 that you want to receive, that you will receive back, is inclusive of the return you want to earn? Inclusive of the return you require to earn 10%? Now think, apply your common sense. What amount would you be ready to pay? What amount would you be ready to pay in the form of investment today if you will receive 110 from it after a year and you want to earn 10% on it? What will be that amount X today, on which if you want to earn 10%, it will become 110 after a year? Because what I will get back, I know it is 110. How much I want to earn on this is 100, that I know. How much I should invest for that, that I don't know. Isn't it a common sense? That if I have the future value, if I have the rate, I can find out the present value. And this common sense become the fundamental principle of valuation, and such a huge concept, a huge profile of valuation in the real world. Everyone, present value of future cash flows is the value of an asset today. How much will I be ready to pay for that asset? Rupees 100. Sir, why? Because I know 110 is my future cash flows. If I discount it by 1.1, I will eliminate from it my earning component. Discounting means eliminating, right? You are making a number smaller when you discount something. So if I remove from 110, what do I want to earn in the form of return? Automatically I'll be left with how much I can invest. So from 110, discounting it by 10%, give me 100 rupee of present value. This is the component which I can invest, because receiving 110 in that case will give me 10% of return. Could I, everyone in the class, explain to you the simple common sense? That why do we say that value of asset is the present value of all future cash flows? Comfort, discomfort, I'm not sure if I could explain it or not. Everyone, quick. Could I explain? Yes, no, quick, quick, quick. Live people, recorded people, could I explain? So, we will talk about it. We will talk about it. What is the common sense? As we said, Acha, so before that, Before that, let us first of all write down what are the different types of cash flows you can receive from any asset. Sir, if you talk about equity share, what I will receive from my equity share are dividends plus plus sales proceed. Imagine that I'm selling a share at the end of fifth year. Imagine I'm selling a share at the end of fifth year, which means, do you agree? After 5 years, whatever cash flow I will receive is also the cash flow generated from that asset now. So, sales price. Similarly, when you make an investment in the bond, what do you receive? Sir, coupons. Interests which you receive are officially called as coupons, that you will learn later on in details. Coupon plus redemption value. Write it down, redemption value. Right? If you talk about, acha, one second. Kindly consider. I need to make you people write this in a different manner. Write it like this. Because what do we write down? Value of equity share is equals to value of bonds is equals to present value of this, and similarly value of any other asset is present value of cash flows generated from that asset. Easy, basic. What is the logic? Logic we have already learned. I don't think we have a need to write down anything over here. All right, cool. So, dividend discount model, as the name itself is saying, consider dividend as its base. What are the future cash flows in our case? The dividends, right? In this case, you can have two possibilities for you in the exam. Possibility one, when you are holding a share for particular number of year, for example 5 year or 10 year. In the second case, examiner will not tell you for how many years are you holding the share, which means in a sense you have to assume that you are holding the share forever. In two different cases, we have to think and find out the value. And obviously, the common sense of all the thoughts will be fundamental value, which is the present value of future cash flows. Sir, if I am holding a share for a particular number of years, then let me tell you. Imagine I hold the share for 5 years, which means I will receive the dividend of 5 years. So, value of share will be present value of D1, D2, D3, and so on till Dn. So value of share is D1, D2, D3 and that way Dn. Along with that, do you agree that not just I will receive the dividends, at the end of fifth year, at the end of 10th year, whatever year, I will also receive the sales price, right? So present value of all those dividends, let me write it in this manner, plus the present value of sales price. Hold on now, please hold on. I think I should make you people write this in this manner. Hold on. So at the end of whatever number of year you're talking, do you realize what is the word n year? N means whatever number of year. 5 years, 6 years. So if it is 10 year, consider the dividends being received for 10 years and the selling price at the end of 10th year, right? You have to, over the time, see, as you will get the flow of our class, you will over the time get the sense of how do we present. We had a choice of writing down the formula here, but we don't trust on the formula. We will automatically practice them while solving the questions. Over here, you have to learn that, okay, I have to do the present value. How do we do the present value is a very obvious thing. We will learn it later on. You just leave it on me right now. All right, cool. Sir, for limited number of year, life is easy, right? However, if we are holding the share for indefinite number of years, which means we don't have for how many years we are going to hold it, and also we don't know what is the sales price I will receive at the end of that year, because I don't know which year. I don't have this amount of sale price, which means in this case I will have to assume that dividends are being received for infinite number of years. D1, D2, D3, D10, D100, D lakhs, and D infinity. You will have to consider dividends till infinity, no sales price being received. That is the scenario called, which is covered under this case. You don't have to know this terminology, please, please, please. These are not official terminology. You should focus on understanding that, okay, possibility 1 and possibility 2. If this is the scenario, tell me, can I discount dividends till infinity manually? If I give you 5 cash flows now, that dividend at the end of year 1 is 10, 12, 14, 19, 25. Plus I tell you at the end of 5th year, share will be sold at rupees 100. You can discount them manually. It is 1.1, 1.11 to the power 2, to the power 3, and so on. 5 cash flows can be discounted. Live people, recorded people, tell me, can you discount the things till infinity? Can you do it manually like this by creating a table or an equation? No. In that case, what do? You have to apply maths. Applying maths means we will have to use dividend discount models. Dividend discount models is what you will have to use, which are covered on next page onwards. Easy, basic. Let's cover it up. We will go to dividend discount model. Before that, let us understand one thing. Sir, you told us that you have to calculate the present value of all these dividends and share prices. Or ultimately, you told us calculate the present value of future cash flows. To calculate the present value, what do you need? You need a discounting rate. Can anyone please in the class tell me what is used as a discounting rate? We have learned in the basics. Required rate of return is always used as a discounting rate, right? And required rate of return depends on the risk we take. All right, so for equity share valuation, the discounting rate being used is called as KE, or cost of equity. For the purpose of equity share, since they have higher risk, see, bond has a lower risk, equity has a higher risk, so for higher risk its discounting rate will be higher. Hence KE, cost of equity, is used to discount equity cash flow. If it is bond, a different kind of rate is used that we will learn later on, but for now cost of equity is the required rate of return. You have learned it in inter. Still, let us go through certain basics so that any question be it, we would be able to solve it through this discussion. All right, come. Calculating cost of equity. So see, this is the complete discussion now. Discounting all these cash flows at the rate of K. Similarly, over here we would need K, which means should we first learn how to calculate K? Everyone? Chalo. So let's proceed. Let us calculate the KE. There are different ways to calculate KE, first of which is CAPM, and I want you all to answer. How do you calculate KE using CAPM? Something very obvious, very obvious. Tell me, how do you calculate KE? All right, applying CAPM, है ना? Just 1 second, huh? So making it, hold on for a second. Is my voice 100% clear to you? I don't know why do I, okay, all right. It is fine. It is fine. Cool, cool, cool. CAPM, equation of CAPM, very obvious. Let me tell you this equation in super detail. We will cover in the concept of portfolio, in the chapter of portfolio management, right? For now, we just need to repeat what you have already learned in C enter, which is calculating KE through CM PM is RF plus beta into RM minus RF. Sir, what is the logic behind this will be covered in portfolio management. We don't have to worry about it now. Right now we have to do the application of it, that okay, K will be used as discounting rate, where you should know, you know what is RM minus RF called as? Common sense, common sense. RM minus RF. Sir, RM means return from market. Market means stock market. Hello. RF is risk-free rate. So RM minus RF would be what? Let us apply common sense. Suppose risk-free rate is 5%. Suppose RM is 8%. So risk-free rate in the economy is 5%, whereas the stock market is giving 8%. Sir, why is the stock market expected to give extra 3%? Because of higher risk which is there in the market. Bonds have risk, free security have no risk, stock market has risk. So because of that higher risk, they give you extra 3%, and people in the class tell me, extra risk, extra return of 3% for taking that extra risk is called as what? We have already learned it. We have already learned it. Risk premium. Extra return for taking extra risk is risk premium, and hence you can again relate this cost of equity, which is a discounting rate, which is nothing but a required rate of return. You can relate this topic with the basics. In the basics, we said, right, required rate of return has an element of risk premium. Observe this risk premium, right? So we will write that, sir, RM minus RF is called as market risk premium, and beta into RM minus RF is called as security risk premium. Beta into RM minus RF is security risk premium. All right. So this will be the first way to calculate the cost of equity, and you have to understand that these are not three different options among which you can choose any. No, no, no. These are the priorities. These are the preference. Your first preference for the entire AFM to calculate the cost of equity using CAPM. However, it might turn out to be the case that RMRF not given, for example, which means I will have to now find out some other way of calculating this, right? Cost of equity, which is this Gordon's formula. Gordon's formula. Sir, what is the logic behind Gordon's formula? Let me tell you. How many of you have read it in the C enter that, sir, P0 is equals to D1 divided by K minus G? How much have you have read it? Almost everyone. In the same equation, if I want to solve this equation for Ke, what will Ke be equals to? It will be like D1 divided by P0 plus G. So another way of calculating K is using Gordon's formula, which is through this equation. All right, let us proceed. I will say K is equals to, however, this should always be your second priority. If this is not possible, then only you do this. All right. Third one, sir, this I will explain to you later on, not now. Later on, not now. Sir, is there an independent logic of this formula? Yes, there is a logic. Sir, as an investor, as an investor, what do you earn? Sir, by investing P0, I earn dividend. By investing P0, I require to earn dividend, first thing. And over and above dividend, I also require to earn the growth in market price. Over and above dividend, I also require to earn the growth in market price. Hence I say my total earning as an investor, as equity shareholder, my total earning is made up of two things. First, the dividend I will earn by investing P0, and also the growth I will earn. Hence my required rate of return is made up of two things. And do you agree, my equity shareholders required rate of return is cost of equity, which is used for discounting. This is the independent logic. Sir, if the data of growth or P0 or such data is not given, then what do I do? Last option, third option, which is earnings yield. How many of you remember I said if you listen, if you use this word yield, it is always a return which is based on what? I said it specifically for yield, that yield is a kind of return based on market price. And this time I want to calculate return against my, like a return in the form of earnings. Sir, dividend yield was DPS divided by MPS. So earnings yield will be what? Earnings yield will be EPS divided by MPS. I want to find out the return calculated on the basis of earnings. So EPS divided by MPS. Sir, EPS divided by MPS formula looks similar to something we have read in the basics. Go back everyone, scroll the pages of your basics. Find out that this formula looks similar to something which we have already learned. Take your time, I'm giving you 30 seconds. Go back, find out in the basics how does this formula look like. EPS divided by MPS is similar to something we have already covered. Someone says it is related to P ratio. P ratio was MPS divided by EPS. Don't write it down, please, please, please. Wait, sorry. Or you will write it. Wait. P ratio was MPS divided by EPS. Earnings yield is EPS divided by MPS. Which means, can I say this is also equal to 1 by P ratio? So if I am given P ratio, inverse of P will be earnings yield, which can also be used as K in the worst case. So unofficially you have also covered the fourth formula. Requesting your response in the entire AFM, right from this chapter to any chapter. If you need this K, this should be the sequence. These are preferences, not the options. Can we proceed, everyone? Easy basic. Chaliye. Sir, what is this discussion that I will teach you when I come to the questions? All right. Sir, starting with the first model, what I am thinking is to take a break now. Let us proceed to take a break so that after break we can start things with a single flow and solve the questions based on this. Hopefully solve the question in today's lecture. Alright. So let us take a quick 15-minute break. Let us meet back at 9:45 and then we start the discussion on particular models. Alright. Bye everyone. Please be back by 9:45. Alright. Chali. Are we set, everyone? Can we proceed? People in the class, are you back? Can we proceed? Quick, quick, quick. Kindly response. Kindly respond. Give me a quick response. One second now. Chali. So what were we trying to understand was that, sir, if we have to find out the value of company, as we said, either there would be this case of manual discounting, where the share will be held for a definite number of years, or we will have this case where the share will be held for indefinite number of years, in which case we will have to use the dividend discount models. In both the case, we will need to use the K, which has already been discussed over here. How would you use the K? Now we are going to discuss that, sir, in case of indefinite number of years where you have to use the dividend discount models, what are the different kind of dividend discount models? Let us start to discuss that. The first one is zero growth model, constant dividend model. Second one is constant growth model or Gordon's model. The third one is variable growth model, which is here on this page number 15. You know what? Depending on depending upon the nature of dividend, depending upon the series how the dividends will be received, the model gets decided. For example, first scenario of zero growth model, as the name itself is saying, that, sir, dividends will not have any growth. The dividends will be constant. For example, my dividend is 10, then forever till infinity I am going to receive rupees 10 as dividend. If this is the scenario, apply this model. Constant growth model, which means dividends will grow obviously, but they will grow at a constant rate. For example, my first year dividend is 10 rupees. Assume I have a constant growth rate of 10% in dividend, which means dividend for next year should be 11, dividend for further next year should be 12.1, and so on. Right? Which means dividend will grow at a constant rate of 10% for till infinity. And if this is the scenario, I have to apply constant growth model, which means you have to identify the pattern of dividend, and accordingly you would be able to apply which method, you will be able to choose which method to apply. Starting with the first one, just hold on for a second, All right. Starting with the first one, which is zero growth model. If you imagine the cash flows, you would know the formula is what I want to tell you. Imagine that you are receiving dividend, the same amount of dividend for infinite number of years. Can you tell me, if I want to discount all these dividends till infinity at a rate called as KE, how will I calculate the present value? Or a calculation of present value has already been learned where in the basics, that if you receive the same amount forever, it is called as perpetuity. Annuity, that form of annuity which is received forever, is called as perpetuity. And right now I want to calculate the present value of those perpetual dividends. What was the formula, everyone? What was the formula? A by R. A was the annuity amount, R was the rate. In our case, we will say P0 or IV0 A means the amount of NAT which is dividend divided by R, which is the discounting rate, is KE. There is a lot of details to be discussed on this, but please start to write at least, everyone. What is this based on? This is based on the formula of A by R. Hold on. This is based on the formula of A by R, where A was my annuity amount, correct? So this blurred ink is actually in the form of pencil. This is the pen ink, this is the pencil ink. So anything which I feel like, mentioning to give you a reference, I write it in this form, which is this pencil. Sir, now what are these terminologies? PV0, IB0, DNK. PV is price at 0 point. What is IB0 is intrinsic value. So with this, let me explain to you what is intrinsic value. Alright, just hold on for a second. This terminology over here. Just hold on for a second. See, you have to understand that price of share which you want to calculate is already prevailing in the market, right? For example, share of TCS we were talking about. Oh my God, the market, just one second. Huh? Will you allow for a minute? I want to check the status of Nifty. 0.7%, 0.07 down, which is fine. Just hold on. IT stocks SVC are down today. Tech Mahindra, HCL Tech, TCS, Wipro. Other than Kotak Bank, these are primarily IT stocks which are down today. Anyways, so we were talking about which company? For example, this company called as Tech Mahindra. My question to you all is, is the price of Tech Mahindra right now is 1375.45. Question to you all is, since price is already there on the stock exchange, what are you trying to find out? Is my question. You are learning dividend discount model, asset based valuation, cash flow based valuation. Sir, if the value is already there, why do we find out a value? So please understand, the value which is already there is the price. But what we want to find out is the intrinsic value. There is a difference between price and intrinsic value. Let me try to make you explain it to you clearly. Let us write it down over here. Price is what is the price, and intrinsic value is what should be the value. The price of share of Tech Mahindra, I know, is 1375.45. I know is the price. But in my opinion, what should be the price of this company? This is the actual price in the market. But if I try to calculate the value of this asset or value of this share, or what should be the price of this share, that is called as intrinsic value. And to find out that intrinsic value, we use these different kind of models: dividend discount model, cash flow model, and so on. So there is a difference between what is its actual value and what should be its actual value, its true worth, its genuine value, its fair value. Are you able to understand difference between the word price and intrinsic value? Intrinsic value is what should be the value, its true value, genuine value. Right? Unlike this is the price, which is actually there in the market. Price you cannot calculate, it prevails. But intrinsic value you can calculate through these methods. But you know what? These words are used interchangeably. I will teach it to you later on, but for now you can see that institute will use these, change these words interchangeably. What is the price in the market is 1000. As per your estimate, intrinsic value is also 1000. Matlab price is 1000 and price should also be 1000, which means can I say the share is fairly valued in the market? The price of the share is how much it should be, which means share is fairly valued, which is why institute uses this word interchangeably. Institute assumes that share is fairly present, fairly valued. Correct? Which is why I'm saying that we will also use this word interchangeably, sometime P0, sometime IV0. Right? Now you have everything in the flow. When you will revise, first of all, you know what is the price, what is intrinsic value, that you know. Calculating the intrinsic value IV, you know, right? And which is why, and once you understand that they are interchangeably used, you will automatically understand why have I used this word P0 and IV0. So if I want to calculate the value at 0 point or the price at 0 point, I will have to use dividend divided by K, the logic of which is already clear. The most important thing which is being taught nowhere else is I'm going to tell you now. Do you agree that dividend of all the years are same? Whether it is the dividend of 0 year, 1 year, 2 year, it is the same 10 rupee dividend. Which one do I consider in this formula here? D1, D0, what? Sir, any dividend. Because if you consider dividend of 0, it is 10. If you consider dividend of 1, it is again 10, which is fine. But can you practically tell me, in this, see, what is this D divided by K you are saying is the present value of future cash flows. But future cash flows from which point to which point? Is it the present value of all the dividends from D0 till D infinity, or it is the present value of all the cash flows from D1 to D infinity? Is the clarity of concepts I want to deliver to you. Please think. Let me tell you, I have to calculate present value of share from D1 to D infinity. Present value of all the shares from D1 to D infinity, and this formula automatically calculates the present value from D1 to D infinity only. In this discussion, through this formula, D0, everyone, through this formula, D0 is not considered. Apply your common sense. Apply your common sense. Do you agree you are calculating present value? If you are calculating the present value at 0 point, then first cash flow will be of 0 point, or first cash flow will be of first year. Or if you have to do the present value, the first cash flow is always and always of first year, and this formula does the present value from D1 to D infinity, hence we have to use D1. But you must be wondering, sir, how does it matter? Since D1 is also 10, D0 is also 10, D2 is also 10, it matters. Not now, you will realize, at some point later on you will realize. That clarity, that depth must be clear to you. So this method is so easy that we don't have a question particularly on this method. We need to move to the next method, after completing which we will solve a lot of questions. So next method, constant growth model. This model gets applied automatically when dividend grows at a constant rate for infinite number of years. This model gets applied when there is no growth in the dividends, which means same amount of dividend every year. Correct? If there is a constant rate, constant growth for infinite number of years, then you apply this model, and this model everyone is also called as Gordon's model. Because Gordon's gave you this formula, who said that if you want to calculate P0, if you want to calculate P0 or if you want to calculate IV0, the formula, as we all know, is D1 divided by K minus G. Sir, what is this formula doing is most important to understand. In this batch, considering the time limit and considering we want to be exam oriented, I'm not focusing on the derivation of this formula. We generally do when it is a 300-hour batch, but obviously right now we want to be exam oriented. We will learn everything which is relevant for exam, and we might have to ignore certain things which looks interesting to us but not relevant for exam. We are focusing on exam right now, right? D1 divided by K minus G, what does it give you? Sir, fundamental remains the same. Please don't miss this. Fundamental remains the same. Even this formula gives you the present value of share right from D1 to D infinity. Which means even this formula does not consider the present value of D0. No, the logic itself says present value of future cash flow. My first future cash flow, everyone, will be D1. All right. So dividend, as I know, is my D1, as I know, is dividend of year 1. K has already been discussed over there, cost of equity. G is very important to understand. G is growth rate. But growth rate of what? Growth rate of earnings or growth rate of dividend? Everyone. Growth rate of what? Chalo, let it be a question. I will talk to you later about it. But growth rate from which year to which year? For example, right now my dividend is 100 rupee. It will increase by 10% and become 11 at the end of first year. It will further increase by 10% and become 12.1 in the second year, and so on till infinity. It will continue to grow by 10%. My question to you all, my growth rate, as I said, should be constant. This growth rate is from which point to which point? People in the class, again, question to you all. Growth rate should be constant from which point to which point? Should it be constant from 0 to infinity or anything else? Think. Live people, recorded people, answer to this question. 15 seconds you are getting. Quick. Let me tell you. Let me tell you, and through that discussion, you will get one more clarity. Have you not read this alternative formula? P0 and IV0 can also be written as D0 into 1 plus G divided by K minus G. Have we read this alternative formula? Sir, can I use any of these two formulas? Tell me. Can I use any of these two formula 1, formula 2? Let me tell you with complete clarity something. Sir, this is the original formula. In the absence of D1, if D1 is missing, then D1 can be calculated as D0 into 1 plus G. But that does not mean that my original formula is this. My original formula is actually this. To me, what matters? To me matters my D1 till D infinity. So even the growth rate matters. Even the growth rate matters from D1 till D infinity. So let us be very clear, right? I need to add one more word over here. Kindly add somehow. And I'm sorry for missing that out earlier. I know there is some cut bit in your book. So I want to use the word sustainable, because examiner sometimes uses this word, and I really want to make sure that the words of our book and the words that examiner uses in the question should match to each other. So sustainable growth rate of dividends from d1 to d infinity, which means when they say my growth rate should be constant, my growth rate actually should be constant from d1 to d infinity, which means are you trying to say, sir, that my dividend can grow from 0 point to d1 at a random rate? Please understand what I'm trying to say. I'm trying to say that, sir, imagine that I'm standing at 0 point. My dividend is my dividend right now is 10%. Suppose dividend in the first year grows at the rate of 15%, which means from 0 to 1, dividend grows at 15%, but after that it grows for second year and for third year at a fixed rate of 10%. Which means when I stand at 0 point over here, I see that my growth rate from 1 to infinity is constant at the rate of 10%. However, my growth rate for 0 to 1 is different at the rate of 15%. Can we apply Gordon in that case? My question to you all is this. I'm not expecting you all to answer the question, but I'm expecting you all to understand the question. My question is, growth rate of dividend from 0 to 1 is different. Growth rate from 1 to infinity is same 10%. Does it meet the condition of constant growth model, or can I apply the constant growth model is my question. Answer will be given later on. But right now this clarity should be there to you. My growth rate which is relevant for this model is 1 to infinity, and it is the growth rate of dividends. And let me tell you, this is the original formula. If not available, we can use this formula. Which means there are few points which are of extreme importance. There are certain points to observe which are of importance. First, this formula will work mathematically only when K is higher than growth. Only when K is higher than growth, the denominator will be a positive number and answer will be positive. If K turns out to be lower, which means denominator will be negative and answer will be negative, which is of no use. Negative share price has no meaning. So first thing. Second, observe that what is used in the formula is D1. And through that D1, as I have already given to you the logic, present value of future cash flow. So if my future cash flow is of 1 year, the present value being arrived is as of 0 point. So just observe that number used in the calculation is D1 and not 0. And similarly, the price arrived through this is at 0 point and not first year. In fact, you can edit it to P1 and P0, which means dividend used is of first year, but the price or the intrinsic value arrived is of 0 point. This is second observation. Third observation, the growth which matters to me, is from D1 till D infinity. And the fourth point, very important one, about the growth in earnings and growth in dividends. Let me give you the complete clarity of concepts. All right, be here. Complete. So in between, I'm missing out on certain points like this or points like this, but it will be covered later on. My objective is not to teach you from the book, but my objective is to explain you in such a manner that you understand everything in flow. All right. So don't worry about what is being missed in the book. We will cover it later on. The book is primarily designed for you to revise. I know in my brains what I have to teach. All right. Chalo, let me now teach to you one more depth about it. Sir, we talk about the growth in dividends or the growth in earnings, and are the two different or same? The clarity of concepts is going to reach you. Sir, this is 0 year where we stand. This is first year. This is second year. If I talk about EPS, sir, my EPS, for example, was 100 rupee. It became, because of 10% growth, it became 110. And because of 20% growth, it became 132, right? So let me put it down. The growth in EPS was 10% and 20%. So obviously, as my company does more revenue, it does more profit, and that's how my earning went on from 100 to 110 to 132. Obvious, ठीक है. Do you agree how much dividend I have to distribute out of earnings is a calculation of dividend payout ratio? People in the class, how many of you remember that basics of AFM? Dividend payout ratio. What percentage of earning you distribute is dividend payout ratio, and what percentage you retain is retention ratio. Let's imagine that in the year which has just ended, my payout ratio was 40%. Or let's say my payout ratio was 50%. For the next year again, I keep my payout ratio as 50% only. Can you people try to think and tell me the amount of dividend? Everyone. The year which has just ended, since my EPS was rupees 100, of which 50% is I am distributing as dividend, then obviously my dividend per share for 0 year will be rupees 50, and my dividend for next year will be 110 being the EPS of next year, 50% being the payout ratio. So 50% of 110 become 55 rupees. I know the growth of EPS is there with me. I know the payout ratio is there with me. Can you calculate, everyone in the class, the growth in DPS? People. How, at what rate DPS is growing? So if I have to calculate, let us consider red pen over here. Color coding is very important in our book, which is why we have tried to make the book even literally very colorful. People think, or wait, the growth of dividend is how much? 10%. Why is it turning out to be 10%? Sir, obvious common sense that if my earnings grow by 10% and in both the years I am distributing a fixed part of earning. Sir, here I earned 100 rupee but 50% is distributed. If this grows by 10% and 50% of which again I distribute, obviously my growth of dividend will also be 10%. Which means over here when they said dividend and when they talked about growth, did they talk about any of these two? Because earnings and dividend grow at the same rate? No. Not always they will grow at the same rate. They are specifically talking about growth of dividends. Earnings and dividends grow at a different rate. I can teach you how. Now, for example, my dividend grow at the rate of 20%. Earnings grow at the rate of 20%. Now I'm saying something which you don't have to write. Let's assume that my payout ratio is again 50%. Can you tell me what will be the number of EPS? Sir, 130 DPS, 132 into 50% is 66 rupees of DPS. And what turns out to be growth rate when DPS grows from 55 to 66? Sir, it turns out to be 20%, you can check. Which means growth of earning is always equal to growth of dividend. But let me tell you one thing. Let us assume this time, everyone in the class, please observe. Let us assume this time that my dividend payout ratio changes to my dividend payout ratio changes to 60%. Which means, do you realize this time of rupees 132 you will distribute 60% and 132 into 60% turns out to be 79.2. My question to you all is, can you please observe, if that is the case, how much my growth rate will be? 79.2 minus 55 divided by 55. If I observe everyone in the class, growth rate of my dividend turns out to be everyone 44%. There is something you should observe, that My EPS is growing at 20%. My EPS is growing at 20%, but my dividend is growing at the rate of 40%. Why? Because this time my payout ratio has changed from 50% to 60%. Obvious common sense, sir. 110 ka 50% is 55. If this grows 20%, my dividend should also grow 20%, provided I distribute only 50%, same as earlier. This time, if I give is my just hold on for a second. Is my audio now clear? Must be, na? No sound, no sound. All right, wait. Just tell me, where could you listen it till? Sahil, just confirm me once. Where, like, till where you listen to me so that I can figure out where to start it from. Sahil, are you okay with this number 79.2? Tell me this. Matlab, could you listen me to me this, till this point? You must be okay because you may be brilliant, right? Live people, could you all listen to me till 79.2? Yes, no? Chalo, let me re-explain. Don't worry. Matter of few minutes, I can re-explain. So what we did, we said that, sir, if earnings grow, we said that if earnings grow by 10%, right? Dividend also grew by 10%. What was the reason? The reason was payout ratio is 50-50% in both the case. Then we said Then we said that, sir, at the end of first year earning, EPS was 110. Suppose business did well and EPS grew by 20% to 132, right? Of which, if I distribute 50% again, what will be my DPS, dividend per share? Sir, 132 into 50%, which is 66 rupees will be the DPS. Right, repeating again for your context, sir, in that case, what will be the growth of dividend from 55 to 66? It will again be 20%. Hence, again proved that growth of dividend and growth of earnings is same. But you know what? This is same because payout ratio is constant. Let us assume a case where we change the payout ratio to 60%. Sir, I have earned rupees 132 in the form of EPS, of which how much to distribute is my choice. Suppose I decide to distribute 60%. So if I distribute 132 into 60%, 132 into 60%, I will get 79.2. Right? Now you calculate the growth. Everyone, now you calculate the growth. If something grows from 55 to 79.2, how much is it turning out to be in percentage terms? Sir, 79.2 minus 55 divide by 55, basic growth calculation gives you 44%. So it is shocking to observe that my EPS has grown by 20%. Despite EPS has grown just by 20%, my DPS has grown by 44%. How has that happened? Obviously, sir, if 50% of something is distributed, it is a lower number. EPS has grown by 20%, which is fine. But of that higher number, this time you are distributing a further higher percentage. Of that higher number, 132, this time I am distributing 60% rather than 50. I am distributing 60%, obviously will lead to a higher number of DPS. The logic is clear. In conclusion, what have you learnt? Let me tell you, and then you all need to give me your yes or no. Let me tell you in conclusion what you have learnt. You have learnt that if dividend payout ratio, please listen to the conclusion very carefully. This is the clarity of concept that I talked to you in the class. If if the payout ratio between 2 years is same, if the payout ratio for 2 years is same, then growth of EPS between those 2 years and growth of dividend between those 2 years will be same. If the payout ratio, imagine on the timeline, if the payout ratio for 2 years is same, growth of EPS and DPS between them will be same. However, if payout ratio of 2 years changes, then growth of earnings will not be the growth of dividend between those 2 years. Growth of earning between the 2 years will not be same as the growth of dividends for these 2 years. Which means now it clearly conveys to us that in our formula, in our Gordon's model, what matters to me is the growth of dividend. They may be same as earning, but it may be different from the earnings. And what matters to me is this growth and not this growth. Everyone in the class, could I explain to you with complete clarity the importance of growth in this formula, and also not just the importance that the growth of dividend is considered, but also the growth of dividend from first year till infinite number of years. 0 to 1 does not matter to Gordon formula, because Gordon starts from D1, it does not start from D0. Clarity of concept, I need your response, everyone. How much out of 10 are you comfortable and satisfied with this learning? People, how much out of 10 are you settled? Recorded people, live people. Please confirm. And if you have any doubt, the space is all yours. You may please ask. Kindly respond. If any doubt, I'm all there for you. Sahil, are you able to process what is going on? Are you able to understand it clearly? Or what is happening? It means that whatever growth they have to give, constant dividend growth should change payout. I didn't get it, Sahil. Sahil, Sahil, it means that for you to be, let me complete, Sahil. Sahil, for you to be able to apply this model, this model says that my growth rate of dividend, my dividend grows at a constant rate till infinity. This is the condition. So you should check the growth of dividends and not the growth of earnings. If examiner says my earnings grow at a constant rate, you don't have to blindly apply Gordon's. No. See if the payout ratio is constant or not. If the payout ratio is constant, which means dividend would also grow at a constant rate, and then you can apply Gordon's model. But if the examiner is silent about payout, then also you can assume it to be constant. But if examiner says it has changed, you cannot apply Gordon's directly, is what I'm trying to tell you. Yes, growth of EPS doesn't matter because they can change payout. However, if the payout is kept constant, growth of EPS can be considered as the growth of dividend and question can be solved. This is the clarity of thoughts, and these 5 small points are always to be considered while solving a practical question. And with these points, I want to make you people realize the beauty of outnotes. Can you imagine? Let me explain to you two possible cases. Imagine that there is no such notes. Possibility one, everything I make you people write down in the class itself, we start to write on a blank notebook, blank copy. Do you realize I cannot make you write down so many things with clarity? I cannot make you people write down. It will end up consuming a lot of time. We have grown, we have become matured, so we can focus on writing the important things and focus on understanding other important things but not write them down. Are you understanding? We have in the last 30 minutes learned the things with such clarity. Why? Because we didn't have to focus on writing them down. We had to focus on understanding them. Possibility 1. Possibility 2, sir, if everything in the notes is written, in the market there are just two possibilities. Everything is written, nothing is written. This is our creation, which you are getting an advantage of, where something is written and more important we write down. Important things are written, more important we write down. Sir, if everything would be written, everyone, you would never be able to focus on such things which I make you highlight. It is only when you write at your own in this manner, you remember it, you feel and you realize the importance of it. When you at your own write down that growth of dividend from this point to this point, it matters. When you yourself write down that, okay, this is the main formula, this is the substitute formula, you realize the importance. If you don't write down, if everything is written, you don't retain it with that intensity, is what I want to tell you. So this creation of semi-structured notes is the best combination, how much my retention should be, and at the same time, how should I save my time, which is why I said that this quick batch of 200 hours is going to make your concepts far more clear than the regular batches of 300 hours. Are you understanding? Obviously not our regular batch of 300 hours, because these are the same notes we use over there. Then what is the change in regular batch? All that is not the concern here. What I'm going to tell you is that this batch is very comprehensive. All right, chaliye. You are lazy, Sahil, to write down so many. And Sahil, we have grown up. I should not be dictating things to you like a kid. We should be focusing more on learning the things. You are here to evolve your brains, not to evolve your handwritings, right? Anyways, so chalo, we are done with it now. Great. I will now explain to you, sir, this growth rate. See, div examiner will give you. There is no calculation involved. It will either give you D1 or D0. How do you calculate K is also clear to you. 3 possibilities, preference 1, 2 and 3. The question next is, how do you calculate the growth? Possibility 1, examiner will give you the growth rate. Possibility 2, we might have to calculate it. And the calculation of growth rate, the logic is very simple. Growth rate is formula of growth rate is everyone. Retention ratio, yeah, retention rate into ROE. Retention rate into ROE, which means, you remember retention rate, payout ratio, retention ratio. Suppose my payout ratio is 60%. How much is my retention ratio? 40%. Which means, do you realize 40% of the earnings will be retained by the company? Retained by the company, which means the equity capital of the company will increase by 40%. The equity capital of the company will increase, not by 40%, ignore that line, but the equity capital will increase because 40% is retained. On that amount which is retained, if invested in the company, that will also give me a return, right? Are capital of my company has increased, right? And that increased, on that increased portion, if invested, that will also give me return at the rate of ROE. ROE means what? Return on equity means as per balance sheet. You remember the meaning of ROE, not the formula. As per balance sheet, if I invest this amount, how much return do I generate? So if you invest that retention ratio as well, how much would you generate on that? For example, my ROE is 10%. So 40% I retain, which is if invested at the rate of 10%, will give me additional 4% income next year, right? And that 4% additional income is growth only, na? Sorry, 4% additional dividend, that is growth only, na? Everyone? Growth is nothing but the additional income or additional dividend you generate, right? Hence, you can apply this formula of retention ratio into ROE to find out the growth, which means examiner may give you directly the growth or examiner may give you retention ratio into ROE. To be frank, we literally discuss the common sense behind this formula in the class. We create timelines and certain things, but let me tell you, we have to be exam oriented right now. We don't focus on the derivation of the things which we generally do in that 300-hour batch, right? We are focusing on the thing, and obviously, having said that, I have explained to you the logic. On the earnings which is retained, if invested at the rate of ROE, how much additional income will it generate? Retention ratio into ROE will be the additional income, and that additional income is the growth, if you realize. Correct? Hence, the formula of growth is this. All right. There is one condition which I want to make you people write down, but I'm wondering if that is needed or not, because I want to tell you the things which are needed for exam, not for purpose in general. है ना? Hold on, let me think. Cool. Let us not write it. It will make the life complicated because we anyways don't have any question which require that level of knowledge. So for now we are clear. Requesting your responses once. People in the class, are we set? Because if we are set, we are actually all set to move to the question. First question of this batch. And for the first time, we will now open the book called as Outscanner. People, are we ready to go for the question, everyone? Very easy and basic formula of growth. Done. So now you have all the components clear to you. What is dividend, what is growth, and what is KE. And let me now take you to Outscanner, everyone. This huge book has the same content, has the same discussion over. Like initial pages are the same, just like you have in the outnotes. The table of content is same, where we'll start with the equity and business valuation, where also I have given the model wise breakup. For example, I have tried to make sure that the flow of outnotes and the outscanner is same. Just like you have dividend based valuation model over there, I will have the questions of dividend based valuation model over here, right? One thing which you can do if you like is that if you feel like doing it, not needed. Chalo, not needed right now. So what happens is that, let me tell you what I'm trying to tell you. Hold on. For example, we have all dividend based valuation model questions together. But in that, we have different kinds of models. For example, we have this model, third one, variable growth of model. So it may be a possibility that later on you may not be able to identify. In which case, I won't make you people mark. Let me very clearly tell you, I won't make you mark. But if you want, you can mark. So after doing the questions in the class or in the homework, you will have a clarity, right? That from question number 1 from question number 1, for example, till question number 10 or 11 or even 12 or even 13, 14, 15, I think even 16. Huh. Yeah, till question number 16. So for example, don't mark it right now, don't mark it right now. But you would know that from question number 1 to 16, the questions are related to the first two models, zero growth model and constant growth model, question number 1 to 16. So if you want, you can write down like this. So obviously, this is not relevant. This was the example I was taking. This space is actually for that purpose. Don't write the exact question number 16. We will confirm it as we go, but you will have to update such things at your own, and that too if you feel like doing it. No need at all. So similarly, when we go to variable growth model, you can mark down that from question number 17 onwards. This is ignore the practice problem, etc. Things not relevant, but at least this you can mark if you feel like marking. First thing. Second and most important thing, because if you don't follow it, you can claim the refund. I don't want literally to teach you. I don't want you to be my student if you do this. Sir, we have the question and we have the solution to it. Does that mean that we have to look at the solution? Not at all. Since you have the solution already with you, does not mean that you don't note the solution in your notebook. People, to every question we do in the class, certain questions we will ourselves solve in the notebook and certain questions we will solve in detail on the calculator. Which, most important line, which you will have to at any cost solve it in the notebook at your own as homework. Which means after this batch gets over, you will never refer to the solution which are already there over here. You will always refer to the solutions which are there in the notebook which you create. Because if you are not doing so, please claim your refunds. You are not eligible to watch this class. Am I strictly clear? Because there is no substitute of writing. If you don't write in the class, if you don't write at home, you won't be able to write it in the exam hall. Let me be very clear. Are you understanding? So no compromise at this, because otherwise you are literally, ditching yourself and ultimately ditching me as a teacher. I don't want the crowd of students. I want the crowd of those students who can really work hard, right? So in no case you can follow this. You will have to create your own notebook. If we do it in the class, fine. If we don't do it in the class, you will have to do at home. This is the thing you will have to compulsorily do. Cool? Chaliye. So let us proceed. The objective will be, the thought process will be, we will proceed, try to solve all the difficult, ambiguous, tricky nature of questions in the class. Similar, easy, repetitive nature of questions you will do at home. All right. So for example, question number one, extremely easy. You will do at home. Extremely easy. Question number 2 is a very good question. We can start with such question in the class. Let us proceed to do question number 2. Everyone, a company has a book value per share, and everyone, attempt name have been written below every question. When was it being asked? Along with that, if that question belonged to study material, it is being written over here. But one thing, my apology to everyone, not all the questions which are there in the study material I could write this. Listen to my line carefully. All the questions which are there in the study material are there in this book. Are there obviously in this book. But below all of them, not below every question study material is written. For example, this question may be there in the study material, but I missed to write SM over here is my point. Question will already be here. All right, cool. So that See, one should not always assume that, okay, SM is written, it is a study material question, let me do it. This is a study material question, but this may also be a study material question. I missed it to write it, a study material over here, getting it? All the study material questions are here, but I might have missed to write them as my point. Anyways, sir, going to question number 2, let us proceed to understand it. Sir, a company has a book value per share of 137.8. Book value per share? How many of you are able to recollect the meaning of book value per share? Sir, as per both things, you should be able to recollect the formula and the meaning. Everyone, please proceed. As per balance sheet, what is the claim of equity on a per share basis is book value per share. So my capital of 137.8 is invested in the company as per balance sheet for a per share. Cool. Which is total equity shareholder fund divided by number of share is 137.8. All right. Its return on equity is 15%. Return on equity. Formula first, or the understanding first. So on whatever amount I invest as per balance sheet into the equity share, I am able to earn 50%, 15% return on that amount. Okay, okay. ROE is 15%. Cool. It follows a policy of retaining 60% of its earning. Sir, whatever I earn, I retain 60% of it. Fine. If the opportunity cost of capital is 8%, opportunity cost of capital is used as a discounting rate, I told you, which means in this case, this will be assumed as K. 18% is my K. What is the price of share today? In one sense, you might think, sir, how can I calculate the price? Price is there in the market. It is there in the market, which I don't decide. Participants, buyers and sellers in the market decide. I decide intrinsic value. But I said these words will be used interchangeably, which means share is being assumed to be fair valued. Hence, intrinsic value will be the price, and then you can directly calculate the price. I want to give you 15 seconds of time just to understand what information is given. I don't want to go to solution. Just understand what information is given. Take half a minute, open your notebook. Take half a minute, open your notebook. Then we will first understand it and then write it. Think what can be done. Think what can be done. Sir, what do I need to find out? Chalo, let me now teach you how should you think. This is for the first time it is happening in this batch. I would always see, I don't want to show you the solution. I don't want to, give you the solution. I'd rather want to teach you how to think. Sir, examiner asking for price for the share. Obviously, obviously we have read the dividend discount model, so we'll think in that manner. Sir, for dividend discount model, we have different models. We have zero growth model and we have constant growth model, which is Gordon's model. I have to think which one to apply. Sir, I think zero growth model because the information growth is missing. If the information is growth is missing, think can it be calculated? Sir, growth can be calculated using a formula which has ROE and retention ratio, which means the data to calculate growth has been given, which means I will have to apply the Gordon's model. Gordon's model say D1 divided by K minus G is the formula. Think can we calculate D1? Think can we calculate K? Think can we calculate G? Out of these three elements, I have K available with me, which is 0.18. 18% is 0.18. I have growth available with me, as in it can be directly calculated. Growth was retention ratio into ROE, which is 60% into 15%. 60 into 15% gives me 9%, which is 0.09. My point to you all is, calculating dividend is now the next task. Calculating D1 is the next task. I am trying to teach you how to think what all do you need. First to look at what has examiner asked you exactly. Identify which model will be applied and decide the inputs and find out those inputs. Can anyone think how to find out the dividend? Think why would book value per share be given? Sir, what is the formula of book value per share? Let's think common sense, let's think formula. Sir, formula of book value per share. I mean, the formula, the book value per share is given, ROE is given. If you have book value per share and if you have ROE, can you find out the third number out of it? Yes, sir. Book value per share means how much is my capital invested. ROE means how much is the return, which means how much is the earnings being earned on that capital, 15%. So if you apply the formula of ROE, it is EPS divided by book value per share. Hence, if on the book value per share, if I multiply ROE, what do I get? I can find out the EPS. The same thing you can find out applying common sense, that on 137.8, if I earn 15% of EPS, how much my EPS turns out to be? And once you get the amount of EPS, if 60% is retained, everyone, you are guessing it correctly. If 60% is retained, then obviously 40% is distributed, and accordingly I can find out the amount of DPS. Those who are okay with the maths, think it mathematically. Those who are strong with the logics, think it logically, but ultimately you should be able to proceed in this manner. Should we proceed to solve it? Chaliye, start writing down. Everyone in the class, start writing down very quickly. Just 1 second. Hold on for a second. Chaliye. Should we proceed to write it down? What is your question? And let me also open the solution book over here. All right. I hope you have the notebook. Write down the question number. Preferably write down the page number of outscanner so that you don't have to put an effort to find out. In whatever way you want to write down, write down. Huh? All of you are mature. You don't need to blindly follow me on anything. Correct? Come here. Sir, first of all, we will have to find out EPS. EPS is actually book value per share multiplied by ROE. What is book value per share? 137.8 multiplied by ROE of 15% will give me how much as EPS? 137.8 multiplied by 50% is 20.67. Let me tell you, in the exam, while presenting, while you are in the calculation, you don't have to write rupee, crore, unit, nothing. But once you have the answer, write down the currency, it is rupee, dollar, write down whether it is in crores, thousands or whatever, right? So 20.67 is the EPS. Once you have the EPS, can I find out DPS? DPS will be EPS multiplied by payout ratio, and payout ratio is nothing but 1 minus retention ratio, right? So if my, chalo, 1 second, let me write down EPS into payout ratio. It will be better for your revision. Payout ratio. What is your EPS? Sir, EPS is 20.67 multiplied by payout ratio is 1 minus 60%, which is 40%. So 20.67 into 40% is 8.27. Can we please confirm the answer? Is it 8.27? Correct. 8.27. 8.27. One more question. So you know what? It is only when you do the question at your own, there are multiple questions which comes to your mind. First question can be, sir, do we need to write down this formula? Let me tell you, no. Let me tell you, these formulas are so basic, so obvious that you don't actually need to write them down in the exam. You can refer to this solution. Is it written over here? No. Why am I writing then? Because people in the class at the time of revision, you should be able to process what is happening over here. All right, it is only the first question which is by we are writing. Over the time we will automatically follow in the class the trend or the way the presentation, which is how exactly you have to do in the exam. All right, first thing. Second question can be, first that I have explained where you have to write rupee, where you don't have to write rupee. The third thing, sir, the answer which is turning out to be on the calculator is 8.268. How many decimal points you have to take? So for that let me take you to the outnotes, or for now just take two decimals. How many decimals exactly we take, I will explain later on. I'll make you people write it down. 8.27 it is. All right, cool. If you have the DPS, question becomes whether it should be considered dividend of first year or dividend of 0 year. Based on the language, I cannot figure out. See, the examiner can use different kinds of languages. We will see it in the questions ahead. The exam language can be company has paid a dividend. Obviously, with the language, it is clear it is D0. Company is expected to pay a dividend. Obviously, with the language, it is D1. However, at a lot of point, company does not say anything about the dividend like this case as you are seeing it here. What do I assume? D1 or D0? Let me now teach that to you. Everyone, listen to this note over here. Certain things I said I will explain you when the right time comes, and this is the right time. If the language of the question is unclear about the timing of dividend, whether it is D1 or D0, it may be a confusion. It is assumed as D1. Whenever you have this confusion, assume the dividend to be D1 is important. You know what? Sir, is it a rule by institute? Obviously, you know the level of institute. If there would be, if I have to name one of the most ambiguous body in the field of education, in my knowledge, I would name the institute's name. All right. They are never clear with what kind of solution they do. Sometimes they follow this, sometimes they follow this with no clear explanation. Sir, it is our observation. With the time, we have tried to observe the institute solution, and we found that in majority of the questions where it was unclear, they have assumed it D1. There would be certain rare circumstances where they assumed it D0, but you don't have to worry about it, because anyways, you can't mug it up from home. Such things like when do I assume D1 and in which question I assume D0, you can't mug up such things, right? Which means we have to follow what institute majorly follows, which means they assume it to be D1. This is what I want to teach you. All right. So we have this dividend ready, which will be assumed as D1. Sir, do we have the number of KE ready with us? Yes, 80%. Do we have the number of growth ready with us? No, sir, it is needed to be calculated. Growth will be retention rate into ROE. Retention ratio is 60%, ROE is 15%. And how much is 15% of 60% into 50% gives me 9% of growth rate. And ultimately now I can find out P0. P0 is D1 divided by K minus G. This is the official formula to be written. Everyone, let me tell you, this is an official formula. We will have to write it down. Sir, D1 is 8.27 divided by how much is K? 0.18 minus how much is G? 0.09, and that gives you what answer? 8.27 divided by 0.09 gives me 91.89. Rupees 91.89. Someone please confirm. Yes, 91.89 being the answer of P0. Ab you must be wondering, sir, institute answer is 91.87, my answer is 91.89, will I get the answer? Let me tell you, these solutions are not blind copy paste of institute. They are not the blind copy paste of institute. We have made the solution as per our understanding, which are similar to institute, in the sense that institute might not present the answer in this manner. We have presented in the manner which is easy to us and on which institute is 100% going to give us marks. There is a possibility that institute answer would be 91.89 only. These are small rectifications. If we do 8.27, these are small rectifications which we do in the class. Automatically our answer might be similar to institute. My point, most important to you all, is would you be able to remember while when you prepare for the exam, will you be able to remember while doing the revision that in this question I will take 3 decimal points, in the next question I will take 2 decimal points, in the next question I will take 1 decimal points? You cannot, right? So your focus of learning right now should be logic and the broad theme that EPS and DPS will be taken till 2 decimal points. In fact, all the numbers are generally taken till 2 decimal points. Alright, 2 decimal, all the things you take till 2 decimal points to get an answer which will in most of the case match with institute. Am I clear? So you don't have to create a worry about, sir, in this it is still 3, hence the answer is different. What do I do in the exam? Brother, you cannot remember all these things till exam hall. Remember one simple thing, 2 decimal points, and this is the answer, and this is what you have to do even in the exam. Are you people in the class comfortable? Sahil, are you settled with how do we need to present? Kindly confirm. Rest of the live people, rest of the recorded people, follow the solution which is there in the notebook and not there which is there in the book. Because we have to trust our learnings more than the learnings which are printed in the book. Alright, great, fine, settled. So this should be the flow of presentation. Next question, an extremely easy question. Such a easy question that we would do it in the class, but not in a written manner, but on the calculator. So green color, we will do it in the class. Red color, you do it in the homework. And no color, we skip it because not very relevant for exam. Alright. Green one, we do it in the class, but not in a written manner on the calculator. Please be here. A company's beta is 1.4. Alright, we have the amount of beta. Market return is 14%, which is great. Risk-free rate is 10%. Oh my god. Using the 3 information, you can automatically find out something which is called as what? Everyone. Which is called as what? KE. It is RF plus beta into RM minus RF. So beta 1.4, RM 14, RF 10. So it is 14 minus 10 multiplied by beta of 1.4 plus RF of 10. How much is it turning out to be? 4 multiplied by 1.4 plus 10, 15.6 KE. Cool. What is the return based on CAPM? 15.6. Easy, done on the calculator. If risk premium on the market goes up by 2.5 points, what is going up? Risk premium on the market. Risk premium on the market. Let us go to that word in the outnotes. People, market risk premium on the market, which means RM minus RF is going up. RM minus RF is going up means, very clearly understand, sir, it is that 14 minus 10 wala number. Something which was 4 earlier, it is going up by 2.5%, which means this time it will be 6.5. On this 6.5, you will have to multiply beta. Focus on the language. They might have spoken risk premium on the security goes up by 2.5. Listen to this very carefully. Risk premium on the security goes up by 2.5. You know what does that mean? It means that this is the clarity of concepts I want to talk about. We don't focus on writing, we focus on understanding it with clarity. So risk premium on security is something else. It is beta into RM minus RF. Which means if the beta is 1.4, so what is the older risk premium? 4 into 1.4? 4 into 1.4, which is 5.6, right? Security risk premium older. If they say risk premium on security goes by 2.5, I will add 2.5 to 5.6 to make it 8.1. Are you realizing there is a difference? Where do you have to add 2.5 is the point. Do you have to add it to this 4 to make it 6.5, or do you have to add it to 5.6 to make it 8.1? Could I explain this to you? Sahil, all my live people, all my recorded people, the clarity of language is very important and we'll focus on that clarity. If the risk premium on the market, which means market risk premium, which means RM minus RF wala component, that component goes up by 2.5, I will say risk premium will become, market risk premium will become 6.5, and then if I apply the formula, it becomes the easy thing. I don't need to explain you. Listen to this, Nayar. RF plus beta into RM minus RF revised one 6.5 gives me revised key, easy one. Underline this, underline this. Risk premium on the market. Only this component they are talking about. All right. So question number 3rd with that clarity gets done in the class. 4th question onwards we'll figure out what to do, obviously in the next lecture. People, are we set? Any doubt, anything that you want to ask particularly with respect to the lecture or questions that we have done? Next question, let me tell you. Question number 4, an easy question. Question number 4, an easy question. With respect to this, I want to teach you something which we'll learn in the next class. All right, and take the questions ahead. So I really wish, I really hope people, the lectures are making sense. The clarity, the detailings are helping you, the notes are helping you. You are happy with the flow of the class. With respect to speed, we will slightly speed up as we proceed, right? Initially, we are building the base, which is why I'm slow. All right, so great. Let us meet back again in the next session, which is going to take place on Monday at the same time. All right. Take care, people. Bye-bye. Thank you so much for being here live. Bye, live people. Bye, Sahil. Take care. Enjoy your day.